is required. But then a second reason for delegation might be where the time horizon of the principle is short relative to the time horizon that's desirable for thinking about the policy. And this is a thing that's particularly relevant in the monetary policy sphere. For those of you who are taking EC 321, I'll talk about this in the first half of next term. In particular, politicians may be operating with a relatively short time horizon, which means that they're tempted to take advantage of the short-term relationship offered by the Phillips curve to buy a little bit more output at the cost of a bit more inflation, even though in the long run we know that ultimately you can't generate permanently lower output through that route, essentially because of the natural rate hypothesis. All you end up doing is delivering inflation. Governments have realized over time that it's sensible essentially to tie their hands by passing over the responsibility for monetary policy to an independent agency, the central bank. That's not the only requirement for delegation. I think it also makes sense when the objective is clear, which is true in the case of monetary policy, where you can tell the central bank stabilize inflation, try to hit this inflation target. And in that way, you can hold the agents accountable for delivering it. But there is a third element, which I think is important, and people are starting to realize its significance. Is there are problems if the agent's actions, the central bank's actions, have consequences which interfere with the other objectives that the principal, the government, is concerned about. So spillovers onto other things that the principal is worried about. Now, the traditional case for central bank independence, as I've already said, rests on the idea that there's an inflation bias, a tendency for inflation to emerge because politicians exploit the short-run trade-off between inflation and activity in a way that in the long run doesn't generate any more activity, it just generates wasteful inflation. And that thinking and the experience of the 1970s, when inflation took off in many developed countries, particularly high in the UK, it should be said, led a drive towards widespread delegation to an independent central bank of monetary policy and politicians standing back. And the conventional assignment for macroeconomic policy through the 80s, 90s, into the 2000s was basically a world where monetary policy was conducted by an independent central bank pursuing an inflation target, and then politics was concerned with fiscal policy, with setting taxes, government spending to achieve whatever supply side, distributional, etc. Goals it wanted to. Part of the reason as well, I should mention, was it was felt that fiscal policy was a relatively inflexible tool because you had to go through parliaments debating fiscal actions. It took time to change them and so forth. That's particularly an issue, it should be said, in the US. So there was a nice clean separation of responsibilities. And what we've seen in the last decade or so is that clean separation gradually being blurred. And a key driver of this, a thing that provides the context for my talk, is a steady decline in the underlying equilibrium real rate of interest in the world economy. Okay, this is a global phenomenon. It's not something particularly originating in any individual country. We don't observe the underlying equilibrium natural real interest rate. This is the real interest rate at which the world economy is in equilibrium with no inflation. So it's a real phenomenon. It's sometimes called R star in the literature. So people woke up to this in the 2000s, before the financial crisis. We don't observe the equilibrium real interest rate. It's something that has to be inferred, but you get a rough handle on it probably by looking at measures of the risk-free real interest rate backed out of long-term government indexed debt, which has been around since the late 80s. The UK was the first country to issue it, and then progressively more and more countries have issued it. And in the chart here is an estimate of the 10-year risk-free real interest rate derived from these index bonds for a number of countries. Incidentally, it's you'll see the source here is King and Low. The king here is Mervyn King, who was governor at the Bank of England while I was there. After he left in 2013, he spent the next year working with a graduate student in the US constructing this series. Anyway, there's been several explanations for the source of this decline in real interest rates. Ben Bernanke, this was before he became chair of the Fed, while he was just one of the board of governors of the Fed, drew attention to the role of high savings in China, what he called a savings glut, but more generally, demographic forces around the world, with the bulge of baby boomers in their high saving middle years, have also contributed potentially to high savings. Some people also focused on rising inequality, and if you believe that people with higher incomes tend to save more, that might also have driven savings up. And then after the financial crisis, there was increased precautionary saving, people saving to rebuild their balance sheets and so forth. There's also arguments that have been advanced on the other side of the capital market, the savings investment balance, if you like. That again, there's a story that with population growing gradually more slowly, that means there's fewer younger workers coming along, so that you don't need to invest so much to equip the workforce. Also a suggestion from Robert Gordon, the American economist, that underlying productivity growth had slowed because we'd sort of run out of big ideas. Personally, I don't find that a terribly convincing explanation, but certainly it is one that's been advanced. People have focused towards a shift away from physical capital in production towards human capital and knowledge. So that's a reason for less demand for physical investment. And again, after the financial crisis, businesses were slow to start investing again because of the heightened uncertainty. There's also a set of explanations related to the relative supplies and demands of safe vis-a-vis risky assets. So there's lots of stories out there. The literature hasn't come to a clear conclusion about the relative roles of these things, but a lot of these forces are still going to be there going forward. So there's a bit of a sense that we're in this world of a very low natural real interest rate, below zero, probably for some while to come. Now, what are the consequences of that? Well, the first and most important thing is that if the equilibrium real interest rate is very low, for a given average inflation rate, for a given inflation target, you're going to have less room to cut the nominal interest rate, the central bank policy rate, before you bump up against the lower bound. Now, we used to talk about the zero lower bound because the idea was that if you cut the nominal interest rate below zero, then people would just prefer to hold cash instead. Now, what we've found is that you can go a small amount into negative territory. Some European central banks, for instance, have gone into slightly negative territory, but you can't go very far because there will come a point where people, and particularly here it would be the banks themselves, say rather than holding a lot of reserves which are paying a negative interest rate, in other words, they're being charged for them, they'd want the cash instead. So there is a lower bound, but it's a bit below zero. Where exactly it is not terribly important because central banks are close to that lower bound. And because of that, they had to look for other instruments to try and increase aggregate demand when demand fell. Now, this issue first arose back in the financial crisis immediately after the collapse of Lehman's. So in late 2009, late 2008, early 2009. And if you look at the right-hand chart here, that shows you the extent to which central banks' balance sheets have exploded in the last decade, essentially as they've been buying up lots of assets, particularly public debt, government debt, paid for by issuing more bank reserves. Conceptually, what happens here, you can think of, say, the Bank of England buying some UK government stocks and government bonds from an insurance company or somebody like that, and paying the seller with a check that's drawn on the Bank of England. The seller then deposits it in their own bank account, which means that the bank then, let's say the seller banks with Barclays, they've deposited the check that's drawn on the Bank of England in their Barclays account. Barclays now has a claim on the Bank of England. That's how the bank reserves get into the system. Now, in practice, it happens electronically rather than by somebody writing a check, but that's how you can think of it occurring. So at the end of the day, the seller has more cash in his bank account and his bank has a claim on the Bank of England, as well as having more deposits on the other side of the bank's balance sheet. Well, the important thing is that's not where it ends, because you would expect the seller of the debt in the first place, the person who sold the public debt to the Bank of England, to want to do something with the extra money they've got. And typically they'll want to go out and invest it in something else. And that could be buying other public debt, it could be buying private securities, it could be equities, all sorts of assets, it could be foreign assets. And the key thing is that QE, quantitative easing, as these asset purchases are called, essentially work by driving up asset prices generally. It's not just the price of the asset that the central bank buys that's affected, but it ripples out across all asset prices. And then higher asset prices means wealth is higher. It also lowers the cost of investing for businesses, and then that's supposed to raise demand. And There's now quite a bit of empirical work that's been carried out since quantitative easing started, which suggests that indeed it's effective at raising asset prices. So the studies that were carried out of the quantitative easing that was conducted round about the 2009-10 period, when it was first being widely used by the major central banks, suggests that asset purchases worth about 10% of GDP reduced long-term yields by somewhere between 0.5 and 1 percentage point, which is quite significant. It's worth saying that as the yield curve has got lower and lower and flatter, it's reasonable to expect this this effect to become progressively less pronounced. So quantitative easing has diminishing returns, if you like, the closer you get to pushing all interest rates down towards their lower bound. And also when markets are functioning well, the policy tends to be less effective than during periods of market dysfunction, such as we had after Lehman's collapse, and then again earlier on this year in the early stage of the COVID pandemic. Okay, well, what are the issues with quantitative easing? Why is it a potentially problematic tool? It works, it affects demand, but as it's been used to greater and greater scale, so people have become more concerned about some of the side effects or some of the consequences. Well, the first one to focus on are the distributional consequences. As I've already said, the primary way it works is by driving up asset prices. And then that has wealth effects on demand and lowers the cost of capital and encourages investment. The problem is, when you think about it, is that's going to have significant distributional consequences, that it's going to affect those who already have the assets in a beneficial way, makes them wealthier because it drives up the price of the assets they already own. So this is typically older people, wealthier people. And the people who lose out are the people who don't necessarily have assets at the moment, but are anticipating acquiring them in the not too distant future. So that because they now have to pay more to acquire the same rights to a particular sequence of income once they've got the asset. So it benefits the old and wealthy at the expense of the younger people who are potentially going to be acquiring assets in the future, but would now have to pay more to do it. And as time wore on, initially QE was introduced just as an emergency weapon. You know, we thought back in 2009, when we first voted for it on the Monetary Policy Committee, you know, we'd have reversed it all in a couple of years. But the longer it's been around and the bigger the central bank's balance sheet has got, the more concern there's been about these distributional consequences. So, for instance, Theresa May, in her first Conservative Party conference speech when she became Prime Minister, amongst other things, drew attention to this and basically said, you know, it's, you know, we have to put a stop to this, which at the time led to quite a bit of chatter about this. Looked like it was infringing central bank independence and so forth. But it's symptomatic of the fact that this, you know, was a live political issue, and indeed it still is. But even separately from those distributional consequences, there's also other fiscal and political dimensions to quantitative easing. So firstly, buying government debt. looks as if the central bank is engaging in what's referred to as monetary finance. So it's buying the public debt which the government has issued, and in return issuing reserves which pay a very low rate of interest at the current juncture. They're linked to the government's policy rate, to the central bank's policy rate. And certainly in some quarters, particularly countries like Germany, there is great concern about this, because they think back to what happened in the 1920s in the Weimar Republic, and more recent instances, Zimbabwe, also if you look in Argentina, where governments have resorted to essentially financing their deficits primarily through money creation rather than selling bonds. That ultimately leads to accelerating and higher, even hyper inflation. And that's one of the reasons why in the Eurozone, the founding treaty for the European Central Bank prohibits it from undertaking monetary finance. So it's not allowed to buy public debt directly from issuing governments. Now, if we just turn to the UK, the Bank of England now holds 40% of the public debt that's been issued. So it holds a pretty big share. And even if you don't get worried about the sort of monetary finance aspects, I mean, the policymakers at the Bank of England would say, well, this isn't monetary finance because we will reverse it when we need to, when inflation is taking off. But even independently of that, it's worth noting that holding a lot of government assets and financing them through reserves, which pay essentially an interest rate that moves with the central bank's policy rate, therefore a floating interest rate, creates fiscal risks. So at the current juncture, by buying a lot of the debt that's been issued this year, so this year the UK government is going to be running a budget deficit of the order of 20% of GDP as a consequence of the actions that it's taken to fight the COVID pandemic. And pretty much all of that has ended up being bought indirectly by the Bank of England. Now that's lowered the fiscal cost because the rate that's paid on reserves is so low. Bank rate, the Bank of England's interest rate is so low. But what it does do, and this was something that in our economic and fiscal outlook at the OBR that was published just on Wednesday, we wanted to bring out, was that a consequence of the Bank of England holding all this public debt financed by reserves, although it lowered the immediate fiscal cost, it increased fiscal risks, so that if the Bank of England had to raise bank rate to keep inflation under control, it would lead to a big increase in the costs for the government, because all of the profits or losses for that matter that the bank makes on these transactions all flow back to the Treasury at the end of the day. Secondly, if you were worried about buying public debt, you might say, well, the central bank could buy private securities instead, private bonds. There's always the risk of default there. So again, there's a cost to the state. And in recent years, although central banks have bought primarily public debt, they bought some private securities. In Japan, the Bank of Japan has even gone into buying some equities. And there's not only the risk that the value of those equities may change, but also equities carry control rights. So you get voting rights over the company. So, and if you like, they're sort of part nationalization. So that's a deeply political act. And then finally, quantitative easing, because it affects interest rates, the whole yield curve of interest rates, tends to affect exchange rates, it affects capital flows, creates international tension. When I was at the Bank of England, I used to go to international meetings, and it was a time when there was a lot of pushback from some of the emerging market countries who were dealing with the consequences of the actions that ourselves and the Americans were taking with quantitative easing, so-called currency wars. So this is territory that's all, well, there's a marked interface with what the political authorities are doing. It's not an action which is devoid of spillover effects. Let me just then turn to say a few words on helicopter money, because helicopter money might look like at least avoiding some of the bad distributional consequences. People have sometimes referred to this as people's quantitative easing. They say quantitative easing's benefited the rich, but what about something that benefits everybody? And the idea here, and it goes back to a noted paper that Milton Friedman wrote, when he pointed out that the central bank could always get the price level up by scattering banknotes out of a helicopter. And then people would spend the cash and that would drive up the price level. Well, doing that looks as if it's not quite as objectionable, because everybody gets some of the cash instead of it being concentrated through the rich. The thing to be said here, though, is that helicopter money, just from an analytical point of view, is essentially a combination policy where the government cuts people's, say, income tax and finances it by selling bonds. And then the central bank buys those bonds. So quantitative easing, and those bonds are supposed to be kept permanently if this monetary injection is permanent. Importantly, though, the income tax cut is just quite short-lived, and the period that it's short-lived, finance it by selling bonds, and then those bonds are held permanent by the central bank. When you think about it, your consumption theory will tell you that's not a very smart thing to do, because people are going to save most of a temporary improvement in their income. It's also true that because the reserves are paying interest, it's not literally distributing cash. The wealth injection is less than it appears. And then finally, there's a question of how you can possibly make it credible to market participants that this quantitative easing is permanent. And in any case, I think there's an argument for saying that what the Bank of England, say, has been doing is not too different from quantitative easing anyway. Both during the Great Recession after the financial crisis and again during the current pandemic, the bank has ended up buying a lot of the bonds that are being issued to meet the extra deficit the government has been running. But the central bank will reverse that quantitative easing but only if it's consistent with hitting its inflation target. So in a sense, they're doing something that is not a million miles away from helicopter money. And that's why I put this chap on the right. Those of you who know your French literature will know it's Monsieur Jourdain from Molière's Le Bourgeois Gentilhomme. Monsieur Jourdain is a sort of nouveau riche upstart who comes into lots of money and pays for a tutor to teach him all sorts of things, including the difference between prose and poetry. And Monsieur Jourdain is flabbergasted to realize that he's been speaking prose all his life. So maybe helicopter money is not so different from what's been going on already. It's not really something that's all that different. You could have a temporary income tax cut if you want. It's really a question of the fiscal policy that's pursued. It's not really something that is conceptually that different. At this point, it's also worth saying a few words about modern monetary theory, which is very much flavour of the month. The initials here, MMT, happily coincide with another acronym, Magic Money Tree, which has cropped up in political discussions. Modern monetary theory is something that's originated from the sort of heterodox schools of economics, particularly the post-Keynesian, as they're called. And the line of thought of these people, or the argument, is that the obsession with governments financing their borrowing by selling debt is misplaced, that governments can never have a problem financing their spending if they create their own money, if they've got their own central bank that can issue more money. If you're a government that is not in that position, say if you're a member of the Eurozone, if you're Greece or France or Italy, well, you don't have direct control over the issuance of euros by the ECB. But if you're something like the United States or the UK, the central bank can issue more cash if required to pay for the deficit. So that's the first point they make. Consequently, there can't be an issue about defaulting on the debt or anything. If the debt's denominated in your own currency, because you can always print the currency required to meet the interest obligations on the debt. And it also means that you don't have to tax or borrow before you spend. You can print the money first. You might decide you want to tax or borrow, but you don't need to do it first before you spend. Instead, the limits to spending are really posed by the supply capacity of the economy. And if you try and spend too much, that'll generate inflation. And what you should then do is remove the excess money in the economy through raising taxes or borrowing, because borrowing essentially takes some money out of the economy too. So bottom line, fiscal action needn't be constrained by concerns about debt. That in a nutshell is the modern monetary theory argument. Now there are some extraneous bits that modern monetary theory advocates put in, often like a job guarantee and stuff like that, but they're not central to the argument. Now, I think the thing that's worth saying about the arguments in modern monetary theory, that it can be summarized that there's much that's new and much that's right. Unfortunately, what's new is not right and what's right is not new. So a lot of it is right, but it's there in another MMT, which is mainstream macro theory. So really the first four bullets here are all entirely consistent with standard macro theory. Economists have always understood that you can finance the deficit through selling bonds or printing money and so forth. And there's a big mainstream literature on all of that. And really the issue with modern monetary theory is actually whether you could trust a government to be acting in this way, that if inflationary pressures did start developing, that it would tighten fiscal policy sufficiently rapidly. And if there were concerns that it might not, the financial markets could take action before that inflation even started appearing by selling the currency, which would in turn then push inflation up. And similarly, they might do that with bond yields if they expect inflation was likely to take off. So the real issues here actually relate to whether it is sensible to pass inflation control back to the government. Funnily enough, this actually is the sort of assignment that we had in the UK for the first part of the post-war period. When I was a student, we were still in a world where basically fiscal policy was the prime tool for managing aggregate demand, and monetary policy was pretty much locked down because we were in the Bretton Woods exchange rate world. Interest rates didn't vary very much, and fiscal policy was the primary tool for managing demand. And then that came badly unstuck in the 70s. So to conclude here, what does this all mean for central bank governance? Firstly, the proximity to the lower bound on policy rates and the need to resort to instruments like quantitative easing instead pushes you towards, even if you don't want to buy the full modern monetary theory worldview, it still suggests that fiscal and potentially structural policies need to play a more prominent role in steering the economy than they did in the world that we had in the 80s and 90s and the noughties, when monetary policy was sort of the only game in town. And indeed, I think it is notable that during the pandemic, it is fiscal policy which has played the lead role. And fiscal policy is particularly well suited at the current juncture, because what, say, the UK government has done is needed to close parts of the economy, the parts of the economy that are associated with lots of social interaction, in order to limit the spread of the virus. But the worry about doing that is that you drive lots of businesses into insolvency, lead lots of people to lose their jobs, but those jobs would be viable in the long term once the virus has been dealt with. So that's why the government introduced the so-called furlough scheme, which basically pays people's up to 80% of people's wages while they're not working. That's been very expensive, but it's exactly the right role to play. And they've had other policies, easy loans and so forth to businesses, and giving them plenty of time to pay their taxes and so forth. And it's all essentially the government acting as an insurer of last resort to help households and businesses stay afloat during the period when part of the economy has been closed. And fiscal policy is much better suited to that than trying to do things through monetary policy, although monetary policy has played a supportive role in some of those actions. The second thing is that we should recognize that although we talk about independent central banks, really all central banks are creatures of the state. That's obviously the case with the Bank of England, where it's still owned 100% by the Treasury, but it just has some tasks delegated to it. But even in countries like the US, for instance, the Federal Reserve Act can be changed by politicians. It's a bit harder in Europe because the statutes of the European Central Bank are in an international treaty, the Lisbon Treaty. So you have to get lots of countries to agree to a treaty amendment to change the statutes. But nevertheless, ultimately, they are creatures of the state, and they're accountable in that sense to the electorate at large. They're not really completely independent actors. They get their legitimacy from being part of the state. What that also means is that when central bank actions have important fiscal consequences or distributional consequences for that matter, so quantitative easing, or when central banks are providing lots of loan support to institutions that are in trouble, which was the case during the financial crisis, and again in the current pandemic, the Fed in particular has lent to a much wider range of institutions than it would normally do. Normally, central banks just lend to commercial banks, to the banks in the banking sector. But there's a much wider range of institutions that central banks have lent to in the past decade, and particularly in the US, where the Fed has invoked Section 13(3) of the Federal Reserve Act, which allows it to do all sorts of unusual things in unusual and exigent circumstances, is the terminology. But one of the things that has meant is they've ended up lending to institutions that the politicians have been unhappy about. So a lot of the friction on Capitol Hill in recent years between Congress and the Fed has been associated with these unusual actions. So what you need is a mechanism whereby the politicians can own, in inverted commas, the consequences of the central bank actions. They have to be sort of part of the decision or accept the decision in an open way. Now, in the UK, it's actually set up quite well because the asset purchases that the Bank of England make, which are held in an off-balance sheet vehicle, the asset purchase facility, every time the bank's monetary policy committee wants to buy more assets, it actually formally has to be signed off by the Chancellor of the Exchequer. So the Chancellor is implicitly accepting the fiscal and distributional consequences of those actions. And he could say no if he wanted to. Now, the MPC could say, oh, in that case, I'm very sorry, we can't meet your inflation target. But there is a very clear mechanism, which means the Chancellor is taking on board the fiscal and distributional consequences of the central bank's actions. You don't have quite the same institutional arrangements in, say, the US or the Eurozone. In the US, I've already referred to the tension between Fed and Congress. The Fed can communicate with the US Treasury, and indeed did so very closely during the financial crisis. I think matters have been a bit more strained between the Fed and the current administration, as exemplified by the Treasury Secretary's decision not to extend the capital that the Treasury provided the Fed that supported these unusual liquidity support measures. And there's a bit of a row about that at the moment. With the ECB, it's even trickier because the ECB doesn't face a single fiscal authority. There's as many fiscal authorities as there are countries, and the countries have different views about what's appropriate. So it's much harder to see what is a satisfactory institutional arrangement that brings the fiscal authorities and the European Central Bank together. And finally, I'll just add on the question of whether we should add distributional objectives to inflation in the central bank's mandate. Some people have suggested this. I think this is a mistake because distributional consequences are at the heart of politics, and you shouldn't be delegating it to technocrats to make those decisions. So if there are distributional consequences that a government doesn't like, well, the first best is for the government to use its tax and subsidy powers, its fiscal instruments, to offset them. And in extremis, maybe you want an override capability, such as we have here, which allows the Chancellor to say, no, you can't do that, MPC, because it creates unacceptable distributional consequences. But there, the Chancellor is clearly taking ownership of it in a transparent fashion. So I will conclude at that point. I've overrun very slightly, but it still leaves us a little time for Q&A. And I want to stop sharing.
Well, we have one question from Benjamin. He's asking about the slide where you mentioned Bernanke savings glut, which explains that higher savings drove down real interest rates. Could you explain the link? I couldn't really understand. I understand that it drives down nominal rates, but shouldn't inflation be driven down too? Which would...
No, the key thing here, think about it just with a simple, well, in my day they used to call a loanable funds diagram. I don't know what they're called in EC 210, where Ricardo Rees and Kevin Sheely teach it these days. But just think of a savings schedule and an investment schedule, and this plots on the horizontal axis investment or savings, and on the vertical axis the real interest rate. We would normally think that investment is a declining function of the real interest rate, and savings is an increasing function of it. And then the equilibrium real interest rate is the real interest rate which puts savings equal to investment. And then the extra little thing that you want to put in there is to recognize that those savings and investment schedules probably depend upon the level of activity, level of income. And we want to look at the savings and investment schedules which are associated with output being at its sustainable level, its equilibrium level. So that's, in a technical sense, what R star is.
Thank you. We have another question from Sally. She's asking, do you think the ECB's removal of its self-imposed issuer limit in its net asset purchases under the PEPP is a cause for concern?
I don't particularly. I mean, central banks often have self-imposed limits on the amount of a particular security they can buy. So when we were when we started QE at the Bank of England, we weren't buying government debt of maturity less than 5 years, because that was mainly held, a lot of it was held by the banks. And we particularly wanted to go round the banks, be buying from the non-bank sector. We avoided buying very long government debt because that was held mainly by pension funds, and they were required to by regulation. You know, we had I think it was, you couldn't hold more than 70% of any particular stock in issue. Now those self-imposed restraints have been relaxed here, and the ECB had similar self-imposed restrictions, which it's relaxed slightly so that it can buy more assets. I mean, at the end of the day, you could say, well, you might get in a position where the central bank, is holding all of the public debt. But what then? In a technical sense, the limit to QE is an awful long way off, because you can buy public debt, you can buy private debt, you can buy equities, you can buy real assets, you can buy property, fine art, fine wine, and you can buy foreign assets too. The limit to QE in a purely technical sense is when a central bank has hoovered up all of the assets in the world, and that's an awful long way off. So the technical limit is a long way off, but the real issue is that long before you get to that point, you start running into the sorts of issues that I've talked about, these fiscal, distributional type issues, concern that, if you're buying equities, it's essentially bringing companies under part state control, which is deeply political. So it starts becoming much more awkward for the central bank to do that, and much more important that the fiscal authorities are part of the decision to do it, that it shouldn't be just the central bank doing it on its own. Certainly the more you go into these other assets, the more important I think it is that the fiscal authorities are involved.
Right, we have a pretty long question that just came in. This question is from Ismini. In the US, there's a conversation about canceling in the student loan debt of $1.6 trillion by buying it back. Individuals have shared stories that they have paid back more money than they ever took out, but they are not close to being out of debt since the interest rates on their loans are so high. What would be the benefit to canceling something like this rather than asking lenders to decrease or eliminate their interest rates for the people paying them back?
Sorry, can you just run through it again? I'm not sure I got it all.
Okay, no problem. In the US, there is a conversation about around canceling in the student loan debt of $1.6 trillion by buying it back.
Oh, I'm with you. Okay, right. Yes. So I mean, in principle, a government can do the same with any sorts of debt. So not just student debt, corporate, the loans that might have been made to companies. So at the current juncture in the pandemic, obviously lots of businesses have taken out loans which may be guaranteed by the state. So that's happened here. The government has put in place several loan guarantee schemes. So the banks make the loan to the company or small businesses or whatever. And then if the companies or small business default on the loan, the government then reimburses the bank. So that's what a loan guarantee is. Now, one of the issues that I think will arise after we get through the other side of the pandemic is that there will be lots of people who've accumulated a lot of extra debt. That debt may weigh on their ability to undertake investments, or you may feel, students have built up a lot of debt and it's an excessive quantity and you want to offset that in some way. Well, one thing you could do then is obviously to forgive the debt, and that would be essentially a pure fiscal subsidy. But what often happens with debt relief, so this applies for countries that have borrowed internationally and get into trouble, say like Greece did, or some emerging market countries that have had debt problems, is the debt is restructured in a way that is, say, it has a longer maturity and a lower interest rate, which means that the overall burden of dealing with the debt is lower for the debtor. So there's some cost to the creditor there. The creditor essentially loses some of what he's put up or gets less than he expected back. And at the end of the day, where you come out on this probably depends on where governments think the appropriate burden lies. To what extent should it be up to the creditors to bear some of the pain, as opposed to giving the debtor or keeping the burden on the debtor?
Thank you. I think we have one final question.
Cool.
That's the last one. Okay, I think he wants to ask it personally himself.
Hi, Professor. So my question is about your opinion that the central bank should not consider distributional objectives. So I have two questions relating that. The first is, so why are central banks focusing so much on conducting research about distributional objectives now, if I guess like there's an argument against considering distributional outcomes? And secondly, I think at least recently there's a trend towards politicizing central banks, most notably in the US. And there's the argument that it's difficult for central banks to focus on one thing, and for the treasury to focus on distributional consequences, at least based on what we've seen in reality. So it makes I guess there's the inherent thought that, or a doubt that, how is it possible for central bank actions to perhaps promote the greater good, loosely speaking, if it may actually perpetuate inequality to a considerable extent? Thank you.
Okay, on the first question, why are they doing work on this? I think there's two reasons why you might want to do it. One is a little bit more Machiavellian than the other. I mean, the quite reasonable reason for doing it is to actually understand the consequences of your actions, and possibly may help the design of your policies, in the sense that it may suggest, well, if we do an intervention one way rather than another, it may have more palatable, be more neutral in a distributional sense. The sort of more Machiavellian argument is that, well, the criticism that QE has bad distributional consequences is going the rounds, and they want to be able to push back on that by saying, well, if you look at it comprehensively, okay, as I was saying in my talk, that younger people in principle are the people who lose out because they're going to have to pay more to acquire the assets. But at the same time, the expansionary monetary policy boosts activity, lowers unemployment, and you've got to take account of those general equilibrium consequences and see the whole thing as a piece rather than just looking at a little bit of it. And that helps them in defending their policies where they at the moment. I mean, more general thing though, which the second part of the question I think was getting at, is there is a tendency at the moment to be asking central banks to get involved in more and more things. So, some people have said, well, they should be explicitly taking on board distributional consequences. But there's, for instance, quite a lot of suggestion at the moment that they ought to be given a role in the climate change agenda. Now, there certainly may be an argument for them to assist the political and fiscal authorities, and there's certainly a financial stability reason for them to be interested in climate change issues, because carbon assets could lose value very quickly as we shift from the current carbon economy to a more environmentally friendly energy economy, and that might have financial stability consequences. So that was how Mark Carney first got involved in this territory. But there are quite a lot of people, I think, are looking to central banks to play the lead role in lots of debates and so forth. And I think that this sort of mission creep is unwise. Central banks should be allowed to primarily focus on the areas where they have expertise and where their instruments, because they have control basically on the emission of base money, they're the monopoly supplier of the basic settlement asset in the economy, cash. They should be essentially focusing on those central issues and not being pulled in and required to contribute to all sorts of other different objectives, where actually other parts of government are better placed to deal with them. Now, that doesn't rule out the central bank sometimes playing a useful supportive role. And going back to the pandemic in this country, the fiscal authorities, the Treasury, has been far and away in the lead on that, budget deficit of 20 billion a year or whatever. But the Bank of England has bought assets, particularly during the period of market turmoil in the spring, to stop financial markets collapsing. It's run loan schemes for bigger companies, something called the COVID Corporate Financing Facility. It's provided concessionary finance to banks so that they can lend to small and medium-sized enterprises. And it's done this in a way that's been joined up with the Treasury. The Treasury and bank have regular meetings together. There's a regular monthly bilateral between the governor and the chancellor, so that they're pulling in the same direction. And that, I think, is what you want. So central bank independence shouldn't get in the way of fruitful cooperation and collaboration, and where appropriate, support by the central bank.
Thank you.
You're very welcome.
Thank you so much for your time, Professor. I think we all enjoyed your insightful session today. That was the final question. I hope it didn't drag too long into your time.
No, time for my dinner now. So thank you very much for listening. And I dare say I'll see some of you. Well, I may not see you, but you will see me in EC 321 next term. And I hope to see you at some point before the end of the year. Hopefully by the time we get to the summer, there might be some actual physical activities.
Right, so I'm just going to end the Zoom meeting now, I guess. Thank you so much for your time.
Goodbye.